Hey folks, if you're going to retire here in the next couple of years, you've got to watch this episode. This episode is going to be incredibly important for you, so please watch, please. Welcome to another episode of the Heritage Wealth Planning YouTube channel. I have some exciting news to share with you today from an article I read in the Atlanta Journal and Constitution that talks about retirement income planning, and I want to share this with you because it bothers me, actually. And it's not that I want to bang on the guy who wrote the article, but I guess I'm going to have to in some regard. And I don't want to do that. I feel bad for having to do this because I'm sure I've done many things that people could bang on me for. But this is how you get educated. This is how you learn, is by experience. And one of the things I want to show you is how this article could really lead you down a path that might not be as advantageous to you as what the guy says. And again, not trying to bash the guy. I'm more just trying to show you how this really works and maybe introduce you to a different way of looking at this, because these are retirement income planning scenarios. And as I said in other YouTube channels, you do not get a do-over in retirement income planning. Once you punch out for the last time, it's going to be awful hard to get that job back if you find out that you ran out of money or you're bored or something like that. So you've got to get it right the first time. So I want to share with you the article I saw in today's Atlanta Journal and Constitution. Let me minimize myself here and get myself out of the way. And again, this is from March 7th of 2018. And if I could get the screen to, I was going down. If I could get the screen to cooperate, yeah, there's the headline right there. How happy retirees can spend $82,000 a year without having millions in the bank. Actually, conceptually, I agree with his argument here. And one of his arguments is that it seems like, here you go, how happy retirees can spend $82,000 without having millions in the bank. His premise, which I agree with 100%, is a lot of people seem to think you have to have 2.2 million in retirement accounts or any kind of investment account in which to retire comfortably. It's just silly. I mean, A, if that's the case, we're all doomed because no one has that. I know some people do. The vast majority of us don't. B, no one's going to have that at all. Again, some people will, but the vast majority of us won't. So if we're contingent on a successful retirement of having 2.2 mil in your retirement accounts or investment accounts, we're all in for a world of hurt, that's for sure. So I like the premise of what this guy is writing about, and because I do think it actually leads to a road that could be a little bit less stressful to folks who are considering retirement. I'm actually going to change out of this because sometimes the websites, they don't move as quickly as I like. So I just copied and paste this into a Word doc or a Google doc, and I want to kind of go over what we found here. So anytime we're talking about retirement, we have the happy people at the beach. You know, they're holding hands. That's great. I guess happy people at the beach are synonymous with good retirement planning. But let's go down what this gentleman has said. His research on what makes people happy in retirement uncovered a magic number of about $83,000 a year in retirement. This amount is the average net sum that the happiest retired couples he surveyed spend each year during retirement. I 100% agree with this. 100%. There's actually studies done now that show what a happy person retirement is versus a non-happy person retirement is, and you'd be shocked that it's not about the level of income so much, it's more about the debt level actually, and if the income is guaranteed or not. Sorry, I got an itch in my eye there. If they have guaranteed income and limited debt, regardless of the income source or regardless of the income stream, they're happier in retirement. They've done studies on this, and one of these days I'll dig through my my list of studies that I've kept on my desktop and I'll post it. Off the top of my head, I can't remember, but there's a couple good studies on that, which are wonderful. Because what the gentleman who wrote this is spot on. He's like, you don't need $1 million to live on a year. You just need a certain amount of money and you'll be just fine. And the irony of it is, the reason why you're going to be just fine is because most likely you're frugal. You have never lived large to begin with. Middle-class family, raising kids, paying for your home, sending your kids to state college. You know, maybe not eating out that much, you know, keeping your car for 5 to 10 years, as a Millionaire Next Door book showed. That runs rampant in American society, of the frugality of just middle-class Americans all up and down the U.S. And because of that, you can take a deep breath and realize that that isn't going to change once you hit retirement. It's just not. Now, again, as I said many times, if you start lighting cigars with $100 bills, don't blame me. Don't blame old Josh. But you're not going to do that because you recognize the value of a dollar. You've been trained to recognize that value. And so because of that, you're going to be well positioned for retirement. So I actually agree 100% with this. And I hope that you say, if that's something that's on your mind, you say, yeah, ooh, that makes me feel better, because I can't tell you how many people say, I'm not going to have enough. And you just run a basic analysis and you're like, oh man, you're doing fine. You're doing fine. And I've already talked about this, but commentators on financial freedom during retirement are quick to point out you need $2.2 million stash. Bah, don't care. If that's the case, then we're all doomed, like I said. Just 2.2 million, some people have it, the vast majority of us don't. However, everyone has Social Security. And this is the critical thing in this article that I think this gentleman, well, I don't think, he missed. And I want to talk about that. Because Social Security is taxed differently than other sources of income, and he missed that. And that's a significant error. Significant. And so I want to talk about that. So Social Security is critical. How, when you take Social Security, and I'm not going to talk about this on this video. I'm going to talk about the taxation of it. I'm not going to talk about the strategies, the strategies in terms of getting your benefit, but I am going to talk about the taxation of it. Because the taxation of Social Security is overlooked all the time, and it shouldn't be. And this article is a perfect example of that. Now, this guy does say, well, I had it up there. If you have a pension, you're lucky, which I've talked about in other videos too. I 100% agree with that. If you have a pension, you're in a good place, because most people don't. And a pension is worth its weight in gold. What I do want to point out, though, is he is showing investment income right here. All right, so he's saying basically the rule of thumb, and I somewhat agree with this, it depends on the circumstance, but generally speaking, going to that 4% rule, and I have a video, just look at that, there'll be a thing that goes by that you can clip on about the 4% rule and how to increase and when to increase your retirement withdrawals based on the 4% rule as a premise, because the 4% rule may not be applicable to you. In fact, I'd imagine it won't. Anyway, so he's talked about investment income. The rule of thumb, you can take $1,000 a month out for every $240,000 that you have, and that's 4.166%, so a 4% rule. And I get that. I think that makes sense. So let's go over his example and why I take issue with this. Because essentially he's saying we need to generate a net of $82,000 for a successful retirement. A net. And he's going to get us there by grossing $100,000. And this is where I shudder to some regard. So he's going to gross us that. So basically, let's just say the wife has $24,000 of Social Security income. The husband has $18,000. Let's say they earned a small pension of $8,000 a year. They work part-time for another $1,000 a month, and they have investable income of $38,000. It could be required distributions, it could be dividends, bonds, interest, CD interest, whatever you want to call it. He's saying $38,000, and he uses it to go to the bottom line as opposed to capital gains or qualified dividends. We'll use that, but again, I don't like that, because if it's capital gains, long-term capital gains, it might be taxed at 0, or it could be taxed as low as 15. If it's qualified dividends, it might be taxed at 0, or it could be taxed as low as 15 as well. He's just using it as ordinary income here. Ordinary income is the worst taxation for sure, because it's taxed at a much higher rate than these other two dividends, long-term qualified dividends, long-term capital gains. But for the premise, we'll just use what he's using here. So at the end of the day, he's got $100,000 of total income, again derived of Social Security, pensions, working part-time, and then $38,000 from the portfolio. Just as a side note, if it is required distributions from an IRA, 401k, 403b, or if it comes out from an annuity, it is taxed as OI, ordinary income. So if all that you have is qualified accounts, IRAs, 401ks, 403bs, and or annuities, and you're taking distribution from it, that is 100% taxed as ordinary income, which is your tax bracket. But again, even in this case, it doesn't matter, because I'm going to share with you here in a second. All right, So to generate that $38,000, he is arguing that we need $950,000 in which to generate that $38,000 each year, adjusted for inflation. And that, again, is a 4% rule. I don't have any qualm with that. So he's saying basically we need close to 7 figures in investable assets in which to generate $38,000 a year in income. I agree. It's just more 4% stuff is what I said. Here's where it gets problematic, though. He's using a tax rate of 17.22%. And that's just so far above and beyond what these folks are going to pay in tax. I don't understand where he's getting that from. Never mind qualified dividends, never mind capital gains, never mind anything. These folks are not paying 17.22%. And the first reason is because they have basically the new Trump tax law, they get $24,000 of standard deductions. So at the very beginning, their taxable income is only $76,000 without anything else being considered. So they're not in a 17.22% tax bracket from the very beginning. But also, and this is where I want to bring in on this thing, my little spreadsheet. And I've been working on this spreadsheet for a while. I'm pretty fond of it, as this is bringing up. Social Security is not taxed 100% as ordinary income. I want to be clear how this works. It's so fundamentally important to understand how Social Security works. If you're married and filing jointly, all right, you need to understand what your provisional income is. Provisional income will tell you how much of your Social Security is taxed. Let me move myself out of the way here. Joint filers with less than $32,000 of provisional income pay no Social Security taxes. None. If your provisional income is between $32,000 and $44,000, you'll pay up to 50% or taxes up to 50% of your Social Security benefit. And I'm going to share with you some numbers here in just a second how this works. If your provisional income is more than $44,000, the max you're going to pay is $85,000. You're going to pay taxes on 85% of your Social Security benefit. That's the max. So immediately, the first 15% of your Social Security benefit is tax-free at the very beginning. All right. So on top of the two standard deductions, husband and wife, $12,000 each. That's $24,000 of standard deductions. Wipes off $24,000 of taxable income immediately. On top of that, the very minimal 15% of their Social Security won't be taxed either. All right. So 15% of they had $42,000 of Social Security. That's another $6,300 that won't be taxed. So immediately right there, we've wiped $30,000 of taxable income off their adjusted gross income between those two things. But it gets better for these guys. And I'm going to show you. So remember these numbers right here. So how do we figure provisional income? Well, and you're not going to see provisional income in the IRS tables. There's nothing that says provisional income. It's provision in the tax code from when they raised taxes on Social Security under my favorite president, Ronald Reagan. In 1983, they raised taxes on Social Security, or they put tax on Social Security for the first time, because previous to that, there was none. With this provision in the tax code in that bill of 1983 that said if you make a certain amount of money, you're going to have provisional income, which is going to subject your Social Security taxes. The thing that ticks me off is that was not subject to inflation. It was not indexed to inflation. So back then, and I write about this in my book, by the way, 21 Reasons You Need a Roth IRA, because back then, $32,000 was a heck of a lot more than it is today. We're talking 35 years. I was 13 years old back then. I'm 47 now. We're talking 35 years of $32,000 being $32,000. Essentially, I guess at $32,000, I think I calculated it'd be like $66,000 in today's dollars. So because it wasn't indexed for inflation, more and more people, by no fault of their own, are having to pay taxes on the Social Security benefit. And it's wrong. It's wrong. And then in 1993, with Clinton and the Democratic Congress, they raised it again to put another provision on there to make even more subject to tax. And that wasn't indexed for inflation either. So in 1983, Reagan, 1993, Clinton, bipartisan bashing here, they subjected Social Security income to income taxation without indexing it for inflation. And many, many, many middle-class families are getting screwed because of that, part of my French. And it bothers me. And the fact that no one talks about it is one of my pet peeves, which is why I wrote my book, 21 reasons you need a Roth IRA. All right, so provisional income. What you do is you take half the Social Security benefit, and this is just my formula. I'll show you here in just a second. You add all the other income, which also includes municipal bonds, folks. Tax-free income is included in all the other income to calculate your provisional income, which calculates how much of a tax you pay on your Social Security. So you take half your benefit, in this case they have $42,000 of their total Social Security benefit. We take half of that, then we add all the other sources of income. Now in this case, they had $8,000 pension, plus $12,000 of part-time work, plus $38,000 of investment income. So we're going to add $58,000 here. And now their taxable income is $67,000. There you go. Now the taxable income is $79,000. Again, half of Social Security plus all other sources of income. And again, municipal bonds are included in that. That's their provisional income. Now, when you factor in this right here, and my calculator that I created did that for me, it says how much of your Social Security benefit will be subject to taxation. Well, it's going to be $35,750, but it can be no more than 85% of their benefit. It can be no more than 85%. So $42,000 times 0.85 is $35,700. So we're about 50. So my computer here is about $50 too high, and we're going to take that and we're going to go down here a little bit, and I'm going to show you what we're going to do. So their provisional income, their taxable income now, is you take your total gross, that's everything, and your gross includes your provisional income, $35,700, plus it includes your investment income, $38,000, plus your pension, plus your part-time work. That's your total income. That's your adjusted gross income. Reduce that by your standard deduction, their taxable income is $69,750. That's their taxable income. Now I got to move this guy out of the way. Just bear with me. There we go. That's their taxable income, $69,750. So I got to go to my other chart here, my other spreadsheet that I have, and we need to move that guy back. All right. I can't remember what I put in for the income. So if they have taxable income, what was that again? Bear with me. $69,750. So we got taxable income of $69,750. We put that in my little spreadsheet here, $69,750, which means their total income is their total tax is $8,000. $8,000. Less than half what the author talked about before when he said it was 17%. They're not 17%. They're actually about an 8% effective tax rate. $8,000 is their tax. Again, $79.88. $8,000 are going to round up as their tax on $100,000 of gross income. That's an 8% effective tax rate. Huh, isn't that interesting? Because he was saying their tax is going to be $17,000. I'm saying their tax is going to be $8,000. That means that's $9,000 more he's attributing to taxation for them, which happens to be almost to a penny how much they're going to make in part-time income. Do you see where I'm going with this? What if they're working a crappy old job at Walmart and they don't want that, but they're worried about running out of money because they're worried about that 4% rule. They're like, yikes, we don't want to take out more than the 4% rule, so we have to get a part-time job so we don't take too much out of our portfolio. Well, you're not doing that because you're only paying $8,000 in taxes. So if we subtract the amount of money that this guy's overshowing them for taxation, it's only $30,000 they need from their portfolio. So $30,000 divided by 950 means their distribution rate is only 3.1. That's it, 3.1. Now it gets even better. Let's stop working because I'm saying, look, guys, you don't need to work because you're basing the need for you to work on this faulty tax scenario that's not coming to fruition. You don't need to do it. So don't work. Don't work part-time. What happens now? And this is where it gets exciting. So now they don't work. So we're going to take off $12,000 from all that other income because now their other income consists solely of that pension of $8,000 plus $38,000 of portfolio distributions. And again, They don't need to take $38,000, but let's just use that to compare apples to apples. So now we don't need $12,000 of part-time income. We can use that time to go volunteer at the church, volunteer at the shelter, volunteer at the women's clinic down at the hospital for NICU babies and whatnot. You do whatever you want, but you don't need to work because I'm going to show you why. So now, instead of all of our other income being $58,000, it's now $46,000. Did I type that in right? Yep. Now watch what happens. Total provisional income, $79,000. Hit enter. Now their total provision is $67,000, which means their taxable Social Security is $25,000. So we take the $25,000, 25,550 to be exact. We add to their pension, and then we add 25,550 plus 8,000 for their pension, plus the $38,000 in investment portfolio. So their total gross income, and my calculator does it for me, but just to show you on my trusty old Texas Instrument calculator, it comes out to the same. $71,000 is their AGI, your adjusted gross income. You subtract $24,000 for your standard deduction. Your taxable income now is $47,550, which we go back here. We put $47,550, hit enter, and what do we get for the tax that they have to pay? $5,300. They come back here, they only have to pay $5,300 now. 5,324. One of these days I'm going to get that to work. Oh, I guess you guys can't see that. One of these days I'm going to get this to work better over there. So now their effective tax rate is only 6%. Now remember, we started at 17.22 by working and went down to 8, and now by not working it's 6%. Are they any worse for the wear? No, absolutely not. They're only setting, let's see, they got their total income that they can spend is, we got $38,000 of investments, we got $8,000 of pension, we got their Social Security is $42,000. So now they get $88,000 of gross income. You subtract out $5,300, and their total spending amount, I don't know if y'all can see that, $82,676. So their total income net after taxes is $82,676, almost identical to what it was with the guy who wrote that article. But he had these guys working part-time at $1,000 a month. I'm saying don't work part-time. Save that time for other things that you want to do. And again, if you want to work, I don't have a problem with that, but don't do it based on the premise that you need to if you don't need to. And you're still just as well off as you were when you were working part-time with that article, because the article had your taxes at 3 times literally what it is now. You had to make up that income from someplace, because that someplace was going to the IRS and taxes that you're not going to have to pay. And I'm showing you right here, because of the way the tax code is with your standard deductions and with the provisional income circumstances, you don't have to pay as much in taxes as this article will point to. And it's absolutely silly to say a taxable income of 17% on gross income of 100. The tax code is marginal. The first, let's go back. I'll show you the tax rates here, because I think it's important. Another important thing to understand how the tax code works. Let me get myself out of the way again. Let me move this guy over here. Oh man, I'm running long here today. Sorry about that, guys, but I'm telling you, it's important. You only pay 10% on the first $19,000. Then you pay 12% on the next $55,000 roughly. Then you pay 22% on the amount over that, but that's your taxable income. Your taxable income takes into consideration after your standard deductions or after your Social Security, because the provisional tax on Social Security is different than just paying a broad flat tax rate on Social Security income. It doesn't work like that. So if they went to this guy, and again, I really don't want to bash him, I don't mean to, but if they went to this guy and he said, look, I'll give you a 4% rule on your investments, and they said, well, that makes us kind of concerned because the interest rates are so low, which is where the 4% rule is derived to begin with. And I don't want to be more aggressive in order to make up for the low interest rates. Well, he's going to have to say, you got to get the income coming from someplace. You're going to have to go work part-time. because he's giving them too much of a tax. But they don't have to do that because the taxes aren't what he said. How many advisors are doing this? And that's what bothers me. Now they're going to go work part-time at some crappy old job they don't want when they could have been with the kids or the grandkids or, like I said, at that NICU holding babies who are addicted to crack. The tax code, folks. And I'm not a CPA. Any CPA can read this and say I got it wrong. I'd love to hear it. Tell me why. Get your taxes done by a professional, for sure. But for the love of me, for the love of Mary, make sure you understand what you're totally paying in taxes, because this is wrong. And you could be going to some job that you don't want to do. All right, I've stopped talking about that. Okay. So tell me, has this been helpful to you? If you are about to retire and you don't understand the tax code, oh man, I'm getting angry. Sorry. I don't want to come across like I'm getting angry, but I just can't take it. There's so many different balls in the air when it comes to taxes. Qualified income, dividend income, long-term capital gains. Do you have tax loss carry forwards? How's Social Security taxed? How's your annuities taxed? Or is it last in, first out? Or is it because you have annuitized it, you're getting a return of principal? All these different things come, so you can't just do a broad brush. Oh, you're going to be a 17% tax bracket. And then on top of that, marginal rates. Marginal rates. And we're not even talking about state taxes either. If you lived in Massachusetts, these folks, as opposed to Georgia, everything is different. Because in Georgia, you can have like $65,000 per if you're over 65 years old and not pay any tax. In Massachusetts, not like that at all. Flat rate of 4.5% on your first dollar or something like that. So it depends on your state as well. Okay, enough yapping. Put a comment down below. Love to hear your thoughts on this. It's important. It's important, as you can hear me tell you again and again. Put your comments down below. Give me a thumbs up if you like what we talked about. It turns out thumbs ups help me to help Google and YouTube recognize my content here. So if you can give me a thumbs up, that makes them more wanting to put my content out there for other people. If you don't like this content, hey, just pretend you didn't watch it, okay? But a thumbs up is helpful. Always subscribe, the red button right there, hit subscribe, but also hit notification so that way you can be made aware of new video content we have coming out when it comes to this YouTube channel, the Heritage Wealth Planning channel. Thanks for coming here. Thanks for hearing me rant. And if you have any questions, just put them down the thing there. And I look forward to seeing you in the next episode. Thanks, guys.